Good morning.
Hey, everyone.
Good morning, everyone.
So we're going to do an exercise in self-moderation today. We have no moderators, so we're going to moderate ourselves. So this is how we're going to start. Why don't you introduce yourself, Henson?
That's great. I'm always accused of not being able to exercise moderation, so this will be a good test for me today. So just by way of introduction, I'm Henson Orser. I'm founder and CEO of Soder Insurer. Prior to this, I was his first CEO and helped launch Vara, the first global regulator of virtual assets just down the road in Dubai. And I ran a crypto custodian that we had spun off from Nomura Securities called Komai Inu for 2 years when it went operational in 2020. Bushra?
I will jump in. Good morning, everyone. Thanks for joining us. My name is Bushra Darwaza. I'm currently Managing Director at Galaxy Trading. I manage what we call the principal trading business, which in a nutshell means managing the balance sheet of a publicly traded business. I have been in the space of trading and investing for quite some time, my whole career actually. Started my career at Goldman Sachs, where I traded the US rates options book in New York. Great fun, basically trading a lot of derivatives, and very excited what's happening in our space currently as more derivatives are coming on board.
Well, thanks to ADGM for having us. My name is Tim Grant. I'm the CEO of Deus Ex Capital, which I've realized now most people don't know how to pronounce that. Anna, it's Deus Ex Capital. So we're a $1 billion investment and operating company. We are very squarely in the digital asset space. We have operating businesses. We have a VC portfolio. We allocate to funds, and we also build new businesses. And one of the main reasons I'm here, and you see Core Prime is on my title as well. I'm also CEO of Core Prime, which I'll talk about in a moment, but is ultimately going to be a next generation prime broker for the space. So with that, we're going to ask each other some questions. And I'm going to start with you, Henson, and ask you to talk a little bit about insurance in general. That's the space that you're in. But I guess the question on everybody's mind is why insurance? Why now? How's it relevant to this space? Why is it important?
Great. Well, I can talk a little bit about the genesis of the idea or the project. Both at Komai Inu, we started in 2018, but it took us until about 2020 to get insurance which was suitable for our business. And as a custodian, clearly we needed loss of asset insurance, custodial insurance, like crime and specie when we're holding other people's assets. And then, of course, as operators, we needed D&O insurance, and it was very difficult to get, and we were one of the first to get a comprehensive package from a syndicate in London. And then when we opened a Dubai entity, it was actually difficult to get insurance there. As CEO of Vara, and with our rules and regulations, we required our licensees to get similar types of insurance. And there was very little capacity available, and when there was capacity, it was arguably prohibitively expensive. So I thought somebody should start an insurance company. And in conversations actually with Further Ventures here in Abu Dhabi, as well as WebN out of London, you should start an insurance company and we'll back you. So throughout this year, we have been very busily getting a license from the Bermuda Monetary Authority, an innovative insurance license, in order to provide crime and specie, D&O, as well as slashing and smart contract insurance. And in fact, we just got our operational license finalized last Thursday. So we're good to go as we get the final capital in place. In Bermuda, they have segregated account companies where you can underwrite different types of risk in different buckets that are bankruptcy remote from each other, so that you're not taking one kind of risk of getting claimed on another. We're utilizing that, but also our sort of nuanced or novel approach is that we'll be underwriting in different types of currencies as well. So not only fiat, US dollar insurance for the D&O, because that's what people get sued in, but for crime and specie policy, we'll be able to underwrite in Bitcoin for custodians who are holding a lot of Bitcoin. And for slashing and smart contract insurance, protocol insurance, DeFi insurance, we'll be able to underwrite in the cryptocurrency or the token that's denominated in. So it's super exciting. And of course, for the evolution of the space and for more wide-scale adoption, there needs to be the type of insurance products that give so much trust to the TradFi system that currently doesn't exist in the DeFi and the digital asset space. So that's Soder. Bushra, tell us what's going on with trading and liquidity and what you've seen evolve since the ETFs were approved, and then also how you see the landscape going forward with potentially a regulatory framework coming in with the new administration in the US.
Well, listen, it's a very exciting time. I looked at the title of our panel. It says Big Problems. And there was the liquidity word next to it, and it resonated with me a lot. I think it's a big opportunity in our space. It's not a problem. Our space is very liquid. So that's number one. I think I've never been more excited about our space. We've got a lot of validation, a lot of institutional interest, especially after the ETF launch. Let's start by just thinking about how a big asset manager would look at our space. The questions were trust, liquidity, insurance, all of these in their heads. And I think so far, the new administration that we have on board, we have Treasury Secretary that knows basically, ex-hedge fund manager, knows the ins and outs and the plumbing of the financial system. A new SEC, basically commissioner that has been pretty friendly with the DeFi ecosystem. Kevin Warsh, very well versed in the plumbing of the ecosystem. That brings us back to liquidity. And if you look at the most successful applications right now in blockchain and crypto, number one has been Bitcoin, the most widely adopted kind of application in the ecosystem has been Bitcoin, thanks to the introduction of the ETF. Number two, I call it payments, or more generally, stable coins. That's basically another real way to adoption in this ecosystem. And with this new administration coming on board, we're gonna have a lot of exciting things, and they have a very short amount of time to execute on that. So I've never been more excited, basically, about our space. Bringing it back to liquidity, I think a lot of people look at crypto, and it is a market that trades 24/7. So if you need liquidity and you're basically looking into, I find it exhausting as a mother to be watching this market 24/7. We have teams distributed globally, of course, but this is not the traditional, rates or FX or equity market, even though FX trades a little bit longer, but it's hard to follow a market that's been very volatile. However, with the Bitcoin ETF coming on board, I think more liquidity is coming on board, which means potentially lesser volatility as we basically traffic in this new asset class. That's one. Two, another thing, I just wanted to share a couple of points. A lot of players in the space call Bitcoin liquid gold. If you look at correlations this year of Bitcoin with other risk assets, just the indices, S&P, NASDAQ, and small caps, Russell, we traded anywhere between 35 to 40% correlation to these assets. So it has yet to prove itself as the liquid gold. It is a 21 million coin in circulation. That's basically by definition. However, Bitcoin has been, and the space, very correlated to risk assets. With where we are, last I checked, we have like 100 billion on Bitcoin ETF. Gold ETF is closer to 240. So can we surpass that down the line? Absolutely. This is something basically in the docs. And the newest thing that we just got has been ETF options. That changes the game. So when you think liquidity and people exposed to the asset class, so no matter how you consider it, is it a liquid gold, specifically Bitcoin here, because that's 2 trillion out of the 4 trillion basically in the market. So I'm just talking half of that market at least, and where the bigger players are positioned. As we look at more options coming on board, people can hedge, people can speculate, and that drives the volatility a little bit lower, and it makes the asset a much friendlier asset to be, and more liquid asset to be in as a bigger institutional player. So to just sum it together, I think we have an excellent setup for a great regulatory environment coming in the US after very difficult years for basically serious players coming in and trying to make the space more institutionalized. The introduction of newer, not asset classes, but like derivatives coming into the space will give a lot of freedom for a lot of more sophisticated players coming in to either hedge their exposures, to speculate potentially in this space and do a variety of strategies that every basically hedge fund, kind of like respectable, I guess, sizable hedge fund comes in and tries to play in. And the last part, I think with that, more interest coming in means potentially more capital allocated to it, which goes into a lot of these builders, innovators in this space. There's the liquidity, drives more liquidity into venture. And I'm excited about venture right now because as people are playing in the liquid side of it, they are driving more capital into venture, where we have a lot of amazing founders now coming in and iterating with this newer innovation. Like, I don't want to mention potentially AI agents coming in and the intersection between AI and blockchain, where you're gonna have a lot of these, let's say you have your AI shopping for you on Amazon, you're gonna need at some point some blockchains, crypto rails basically incorporated into this whole AI story, incorporated in our ecosystem. So I'm very excited about that, and I would love to give it to Tim, because we're talking liquidity. I think we have to talk about credit and leverage. Again, those are very important points that a lot of us pay attention to as we're growing into this space.
Thanks, Bushra. And I think you're right. Like, if you think about what we're all talking about here, we're talking about primitives. We've got to this interesting inflection point where we've come so far, but there are big pieces of infrastructure that remain to be put in place to allow for the march towards the growth of the derivatives markets and that risk capital coming into the space, which is going to be that virtuous circle that lifts the entire space up. And one of those primitives is also credit provisioning. And it's kind of the plumbing in the system that we take for granted in traditional financial markets. But if you look at the crypto space, and it's important to recognize, and I think everything we've seen this week and seeing everybody here today, this is an institutional space. You know, we're not talking about crypto hedge funds, we're talking about the biggest players in the space, the biggest hedge funds, the biggest asset managers who want to trade this. And the ETF was the starting gun. Look at BlackRock, like the biggest asset manager in the world, is openly talking about Bitcoin on the regular. But in order for us to get to that next level, we're going to need credit provisioning, which doesn't exist. So the traditional markets really are fueled by prime brokerage. So the largest hedge funds in the world they get their leverage from prime brokers. Those prime brokers are big banks. They're funded by bank balance sheets. They have access to the Fed window. They have access to bond markets. Now, look over into the crypto space and the digital asset space. We've got some great players, Hidden Road, FalconX, Matrixport, LTP, but they don't have the same ability to fund off a bank balance sheet. And so what we have, and I think you will feel it as an active participant in the market, and it's extraordinary. You talk to anyone who's actively trading, they'll tell you they can't get leverage. They can't borrow enough dollars to go and get that leverage in the market. And to be, just so you all know, usually you're talking about 2 to 5, sometimes 10x leverage on the assets you have. So I used to work at a hedge fund called UBS O'Connor. We had $6 billion of capital, but we were trading $24 billion, really, because we got that leverage from our prime brokers. That's the lifeblood of capital markets. That's the liquidity which allows us to go and build these new marketplaces and allows more participants to come in. Again, that virtuous circle. So how do you solve that? Well, interestingly, the parallel with what you're doing, Henson, is there's another market that actually had to solve this problem, the reinsurance market. Can't fund itself through bank balance sheets. So they've now, over decades, they've accessed risk capital from sovereign wealth funds, pension funds, insurance companies, credit hedge funds, by creating these segregated account structures, and it's a well-trodden path. So that's actually the approach that we're going to take, and we think we have to take, because the new risk capital that will provide that leverage for the system can't come from our own system, can't come from our own ecosystem. We can't keep staking and restaking, that's not going to work. We need net new billions of risk capital to come in, and that risk capital will come in when those allocators see a framework that they're familiar with, that feels like, and again, this notion of trust, that's got decades of tried and tested experience in what happens when things go bad, what happens if things go bust, and what happens in bankruptcy. How do we make sure that we don't see a lot of the stuff that went on a few years ago in 2022 when we had our crash? Like, that can't happen again. We need to have a bit more robust. So we are building a prime broker. We're actually intending over the next year on being regulated by ADGM, and we'll also have an outpost in Bermuda. And our goal, and by the way, the demand side of the equation is very, very clear. I literally haven't even opened our business yet. We have literally hundreds of millions of orders for leverage. That tells you that the demand is there. Now we need to go and build a mousetrap that will really entice that net new risk dollar allocator to come in from outside of our space. And again, that's a primitive that we need, and there's others too. So I noticed that we've got 1 minute left, so I'm going to do a very quick throw it over to Henson, and maybe we can all give our 20 seconds last call before we go.
Yeah, I would just say when things go wrong, and as we go to trustless, we go onto blockchain, we go to smart contracts, there still are scenarios where things could go wrong. So where I see the insurance landscape evolving is potentially for protocol or DAO or DeFi insurance, so that if something goes wrong, there's a pool of assets there, mutualized or captive, that gives people the confidence that if something goes wrong, their deposits are going to be safe. So deposit insurance for a borrowing protocol makes all the sense in the world, and that can be self-funded and self-propagating. So that's where I see the landscape going forward.
Well, as the CEO of a company that needs insurance, let's talk right now. I've got to get some insurance. Bushra,
the speaker's lounge.
The last word to you, Bushra.
I would just say pay attention. The market is moving and the space is moving very, very fast. I don't think people can afford not paying attention. We were having this joke with my boss, who anecdotally was his college roommate. And he always tells people, if you're not long, you're short. So you don't have to be long, just pay attention. I think that's my biggest message to everyone.
Wonderful. Thank you, everybody.
Thank you.